Okay. So, as I said, I'm going to go through all these points in the next part of the lecture. Why do economists still cling to the efficient markets hypothesis? Well, partly I think it's fitted the assumptions that they believe the market was in equilibrium. So they're quite happy to assume these quite bizarre things, common rate of interest, everybody believing the same thing, on the basis that it gave them the results they wanted about equilibrium. And they're willing to admit that the assumptions were extreme, but saying because they actually result in the view we have of how the market works, we shouldn't reject it. So I think it's lunatic, but anyway. The proper test is supposed to be the empirical fit. And this is what Fama, you know the name Eugene Fama? That's the one, yep. He was a PhD student back in 1969, and he went gung-ho on this theory. So he'd make his name by being the person who did the empirical work on this paper. And his first published paper on it, back in 1969, found it was a good first and second approximation. That means it's good at getting both the level and the rate of change of the stock market, which is a very, very high level of praise for the model. I think it's that good an empirical fit to the data. And what he did was analyse the data from about 1950 to about 1966. Now I've taken a look at the period from 1914 to 1999, or 2007 in fact. And if you take a look at this, the first sample I showed you back in 1999, then the only time that it's actually close to the line for a long period is the period that Fama and French were doing their empirical work on initially. So you could look at that bit there, that empirical window, and think the fit was pretty good. Then you had the crash I told you about in the last lecture, and then a bubble taking off in 82. So the market was ultimately miles ahead of its trend. So you're not likely to be a good fit. So he actually chose a period that was actually quite stable, without knowing he was doing it, of course. So he had these bizarre assumptions of common rate of interest and homogeneity of expectations, and the defence that it was the proper test is the acceptability of its implications, which is a weird way of putting the argument that all that matters is if it fits the data. It doesn't matter how realistic it is. The person who first put this argument forward was Milton Friedman in a paper called The Methodology of Positive Economics. And he said assumptions don't matter, realism is irrelevant, and in fact the more significant a theory is, the more likely its assumptions are to be unrealistic, because it'll explain a lot by using a very small amount of information. So for example, your GPSs tell you how to get here to the campus without telling you the altitude of the road you're on at the time, or how many trees there are next to you. And Milton's argument is you don't need to know that stuff. Leaving that detail out, assuming they don't exist, is actually making it a better model of how to get to the campus. And that's the defence that Sharp invoked, is that it's okay to make these bizarre, stupid assumptions, so long as the model fits the data. And in summary, that whole defence is false, because it's saying all you need to do is have a model that lets you fit the data, and it doesn't matter whether the model is realistic or not. One of my psychology lecturers when I was at first year uni back at Sydney University made a wonderful example of that. He said, I have a model that the fridge keeps food cold because there's a coldness fairy inside it, and when you open up, the coldness fairy turns into light. And you open the door and the light comes on. Perfect model. Now, it's a bit like the teapot theory, yes. You want to explain that one?
Basically, there's a teapot out there falling around galaxies going through comets and basically you don't think there is.
So, of course, there's many ways to challenge assumptions. They're not sacrosanct. The one obvious way I showed you last week is you can challenge them on logical consistency. If you want to assume that 1 plus 1 equals 3 at some stage in an argument, forget the argument, not allowed. And I showed you proof by contradiction. You can't, for example, assume, just for the sake of argument, that the square root of 2 is a rational number. That involves a logical contradiction. So there's ways to evaluate assumptions and say you can't do that. Equally, trying to aggregate by assuming they're all the same. That's not valid. And if you look at sciences as well, they do actually try to build theories that try to describe reality. The classic example we're living through right now is the theory, what's called the standard model of particle physics, had one missing element called the Higgs boson. And the prediction that had to be there to explain where gravity came from and to complete the standard model led to 40 years worth of research and the building of an enormous particle accelerator in Europe, the Large Hadron Collider, that finally they now believe, statistically speaking, has probably shown the existence of the Higgs boson. So that was a prediction about the nature of reality, because they really believe the Higgs boson exists. And they work to prove that it exists. So it's not a case, I think, instrumental description. They think it's actually what reality is. And Musgrave made a beautiful riposte to Friedman about this whole argument that a significant theory has unrealistic assumptions by saying, well, there's not just one type of assumption. There's basically three classes, what he called negligibility, domain, and heuristic assumptions. And negligibility one says something is not particularly important. So if I say you don't need to know how many trees there are on the road as you drive along it, I'm saying the number of trees is negligible to the issue of making a model of the road. And Galileo's experiment of dropping two lead weights out the Leaning Tower of Pisa and seeing which one hit the ground first, because they both hit roughly at the same time, was assuming that air resistance doesn't matter. But of course, if I dropped a lead weight in a feather, then if I was doing that on the Earth, it wouldn't work. Okay? But if I did that on the Moon, it would work. There's actually one of the Apollo astronauts did precisely that. He dropped, I don't know if it was actually a feather, but he dropped an object like a feather and a heavy piece of metal on the Moon, and they both fell at precisely the same speed, making the point that if you're on a planet with no atmosphere, then any two objects will fall towards that planet at the same speed. That's what you might call a domain assumption. Now, if you're in a domain of a vacuum, it'll work. Theory will be accurate. But if you try that in a domain of a planet with an atmosphere, it won't work. So a domain assumption says if a condition applies, the model works. If the condition doesn't apply, the model doesn't work. And the final type he called the heuristic. This is an example here of Newton's. I'll jump over that one. There's the final example that Musgrave gave, what he called heuristic. And that's where you make a false assumption as a stepping stone to a more valid theory. Now, you can actually regard the assumption that a over b equals the square root of 2 is an instance of that. You guess it, you don't actually know that it's false, but you make it as on a step towards proving there must be numbers which are not ratios of two integers. So that's a heuristic assumption. And Einstein gave a beautiful example of this in a little book where he explains special relativity and general relativity for the public. And he said, imagine you assume that somebody in a vehicle moving across that vehicle, you imagine their speed can be described as the triangular sum of the forward motion of the object and the horizontal motion of the person. And he said, well, if that's a person on a train, it'll work. But if you're firing a beam of particles out of a rocket travelling at 9/10 the speed of light, the sum of the two will be less than 1 times the speed of light. And he said, you make an assumption that it's actually, you can do it at relativistic speeds. And he said, this result cannot be maintained. The law doesn't apply in reality, but it's something you use as a stepping stone to saying, how do we modify space to make this thing consistent? And you then got the idea of special relativity. So, what do we got with the Fisher-Marcus hypothesis in that front? You assume that all investors have got accurate expectations of the future, equal access to limitless credit. Is that a negligibility assumption? Well, obviously not, because even Sharpe says if you drop them, the theory is in a shambles. Now you can't, if you assume there aren't trees on the side of the road, does it mean you can't use the map? That's a negligibility assumption. This is a domain assumption. Heuristic. Well, it could have been a heuristic step. You could have assumed this to begin with, and then said, let's assume, having done that, let's modify it and take into account people actually disagree with each other, don't have limitless access to credit, and are not correct about the future expectations. That could have been a more general theory. But that's not what he did. They stopped at this level. So it's actually a domain assumption. The theory will apply in any planet you can find where people's expectations of the future are correct and where they have limitless access to credit. So once you die, if there's a stock market in heaven, it'll work. So despite the crimes that Sharp had, theory took over because it fitted the biases that economists have to expect equilibrium. And it seemed to fit the data to some extent. You did get the idea of high returns and high volatility, risk-return trade-offs and so on. But I think it's a fluke. When you take a look at the data, it reflects when the data was actually used. So here's the paper published in '64 on the empirical research in the 50s and 60s. And between 49 and 65, you had that steady advance going on. And it kept on going for a short while after the paper, and then all hell broke loose. Now what Fama was looking at was 46 or 48 through to 66. And you couldn't have got a more stable period. And I'll show you how stable it was. Here's the argument about it being, a damn good fit to the data. The one thing he did admit, which is an intriguing thing to notice, and we'll come back to this in the next week, is that he said large movements one day were followed by large movements the next day. So that's actually a characteristic of a fractal distribution. But he managed to ignore it by saying, oh, well, it does happen, but the sign is random. Sometimes it's big and up, have a big movement up followed by a big movement up the next day, other times big movement up one day, big movement down the next. So he said, well, they cancel out, so you can ignore them. It's ignoring the extremities of the distribution again. But here's the range of data from 1950 to 1966. Now, there's a fair bit of volatility in that. You can see obvious ups and down cycles, a couple of obvious little crashes there, but it's nothing compared to the pattern from 1914 to 2009. Much, much wilder. And I'll now bring in logs to show it more clearly. Here's the daily movements from 50 to 66. Change in the log. So very little movement outside the 5% mark. And looking at that, you can imagine that's fairly random. Here's 1914 to 2009. Visually enormously different. But there's the range that Fama looked at. And that's that whole section over there. It's just exactly the same data and scale, just stretched out.
So do you believe there'd never be a repeat of the
Yeah, that's right. All economists think it was an aberration caused by bad Federal Reserve policy, including the bloke who's now boss of the Federal Reserve. Life has little ironies occasionally. So yeah, they never thought it would happen again. They didn't think it was a market phenomenon. Minsky, I'll talk about later, said it's clearly a market phenomenon. So if you're going to have a model of capitalism, the model has to be able to reproduce the Great Depression. If you can't do it, you haven't got a model of capitalism. And that's the way that I've worked as well. So this period of less volatile data, let's take a look at this. That's superimposing the random noise model on the actual data that he was looking at. Yeah?
With that slide you had the last slide,
Yeah.
So if you take out the Great Depression, World War II,
Yeah.
the global financial crisis, and the economic crash,
Yeah.
then it pretty much fits the same trend that was 50 to 65. Doesn't that sort of show that stock markets are fairly consistent, and it's just other global economic factors that disrupt them, but on their own, it's a bonus model.
Yeah. Well, I mean, if you can take a look at those that don't fit your model, you can fit any model you like. Okay. There was Milton Friedman was once described by Joan Robinson as a magician who put a rabbit in a hat in full view of the audience and then expected applause when he took that rabbit out of the hat again later. So if you sort of say, let's leave out all the stuff that doesn't fit the theory, and then look, the theory fits the data, I mean, that's being very pretty. And it's typical neoclassical stuff that they'll do that sort of thing. To say, apart from this, leave out the outliers. So what you have to say is, well, can you build a model which includes the outliers? Or can you not build a model that includes the outliers? Now, if it's impossible to build a model that includes the outliers at all, then there's an argument for saying, well, there must be something really extreme that happened back then.
But would it be impossible in the future to have the ability to build a complex model?
That's one of the few excuses they've got. But that excuse probably died in about 1975. Because by that stage with computers, I mean, I was using, a decent enough computer back then. I would have to wait a while. But I could do most of what I'm showing you now back in 1975. So the excuse that you didn't have the mathematical methods or the computer software pretty much died in about the mid-1970s. So they've been using that same excuse, for a bit long. And they've got away with murder by ignoring reality. It's about time we stop them doing it. That's, again, showing the same sort of thing to the extreme. And it isn't just, notice you've got to be really careful. You've got to slice out the 1930s. Second World War, I've happily let that out. Then you've got to slice out the 1980s, and then 2000, and then now. You start having pretty big holes in what you're trying to predict. There's actually a lovely cartoon that Anwar Sheikh has on his website, which is taken from actually a satire about chemists. Has two blokes in white suits up on a blackboard with a massive equations on one side of the blackboard and a massive equation on the other side of the blackboard. And then in the middle of the statement saying, and then a miracle happens. And one says to the other, I think you need to work on part B a bit more carefully. So I'm not going to allow miracles here. You've got to explain the whole lot. And of course, I'll be showing you theories that do explain the whole lot next week. So there are theories that can do it. So you can imagine filtering out the stuff on the left-hand side as outliers. No way can you do it for the entire data. But that period that you got away with it really gave a chance for this theory to take hold in people's minds and become how they thought their world actually operated, which is why they were totally taken by surprise when the financial crisis hit. So again, looking at daily movements here, simulated versus actual. There's a bit of a gap for the extreme stuff. 1914 to 2009, there's an enormous gap. Over here you've got 400 events, more than 400, that are outside the range of the normal distribution. Over here you've got about 50. Now, over here that range is gigantic, as much as 22 times the standard deviation. Over here, just 6.5 times roughly. So, far more outliers in the full data than you find in the data for the sample where the model was shown to be empirically validated. And again, same sort of story. If you look at again, that range I showed you beforehand, the biggest movements, negative movements in the actual data, the biggest negative movements in simulated, whereas there was nothing at all in the simulated data that even came near the actual for the full range. Here you get more volatility, but there's only 20 that are outside the range. That's 2.185 up there is the largest from the simulated data, and 2.147 is smaller than that. So you get something in the biggest 20 or so, or 30, that's within the data. But 1914 to 2009, no way. Again, I've shown you that one beforehand. There's nothing in the simulated data that overlaps the biggest 100 movements in the real data. So you're leaving out the biggest 100 movements, where one of them was 22% in one day. That'll make a bit of a difference to your portfolio. So it's an aberration of the period used and the stability of that period. If you look back, there was low debt, not much speculation going on, and a very robust financial system, versus the overall period that has 4 major stock market crashes and bubbles in debt, and I'll show you they feed in later. So by 2004, Fama conceded defeat. Now, I see some puzzled faces there, because you wouldn't know it from this. Yeah, you haven't got that in your normal courses, I'm sure. But this is a paper published by Fama in French. It's one of your readings you'll get in the 2004 Journal of Economic Surveys, which is one of the authoritative journals in economic theory. Normally, on the neoclassicals get invited to write papers there. And in doing a survey, he said the CAPM is dead. This is how he put it. Mind you, he still believes in it. He's so wedded to this way of thinking, even though he's disproven it empirically and said so on a paper, he still defends it in conversation, quite strangely. He just can't let go of the belief. Like somebody who's proven God doesn't exist and is a priest. He still can't let go of the religion. Still wears the vestments. So the attraction is powerful. Unfortunately, the empirical record is poor enough to invalidate using it. This is Fama in French. Guys, you're still getting shoved down your throats in other courses, I'm sure, in the opposite direction. And they said maybe the assumption's the problem, so they're now admitting assumptions could be at fault. They said the failure of CAPM implies that most applications of the model are invalid. Now, he admits the unrealistic assumptions, but the key thing here, this is why it's worth reading literature carefully, as well as admitting that people are assumed to have the same beliefs about the future, he also admits that they're assumed to be correct about the future. The beliefs they have is the true distribution. In other words, you have been taught a model of finance that assumes everyone can accurately predict the future, with a bit of random noise around the outside. Now that is delusional. It's not a theory of the real world. And then he talked about the assumptions there. So he assumed, he admits, that model assumed people could predict the future. And now he's talking about assumptions mattering. And for example, he considers maybe you can replace the assumption of limitless access to credit with unrestricted short selling. But he said that's as unrealistic as risk-free borrowing. So now he's willing to reject an assumption because this assumption is unrealistic. Finally behaving sensibly about assumptions 40 years later. And he says as a result you don't get, because you can't get a market portfolio that's sufficient as they define it, then you don't get the relationship between expected return and market beta either. And you might hope the model, still fits the data, but unfortunately, he said the returns aren't related to betas. There are better indicators than beta of what's going to happen with stock market returns, and the risk-free rate and beta relations aren't what you find in the empirical data. But to take you through those, he said there are three implications of the CAPM model. First, that expected returns are linear related to the betas and nothing else matters. The risk-free return and the beta is all you need to worry about. Secondly, the beta premium is positive, so you get rewarded for taking on risk. And thirdly, if you have an asset which has no volatility compared to the market, then you'll get the risk-free rate. He said all three of those are wrong. So he said there is a positive relationship between beta and average return, but it's too flat. If you have the intercept being the risk-free rate and the slope being the coefficient on beta, then you get a higher return, what are supposed to be risk-free assets, and a lower reward for taking on risk. Just looking at it graphically, the straight line is the prediction of the theory. The dotted lines are portfolios formed on the market beta. So breaking the market down into 10 overall portfolios, these are the ones with the lowest beta, those are the ones with the highest beta. Well, yes, you get a slightly higher return for taking on the high beta ones, which is much more risky, much more volatile, but you're getting nothing like the reward you're told you're going to get by doing it according to the theory. So the particular return on the lowest beta is 8.3%, whereas the actual is 11, and the particular return on the highest beta is 16.8, when it's actually only 13. So using it as a guide to how to invest will be misleading. Secondly, saying betas are not the total explanation. So there's plenty of other, starting in the late 1970s, okay? It's quite some time ago. That's how long they could have been arguing in textbooks the model doesn't work. It's how long they've been fighting reality. He said other things matter, and they actually talk about themselves looking at the empirical values back in 1992, 20 years ago. They said size, price to earnings ratio, debt to equity, and book to market ratios all add to the explanatory power of beta. But it's not even that good, because they realise the best guide, forget beta, is book to market value. If you want to use a guide as to how to make more money out of the stock market, what you buy are shares that have got a high book to market valuation, which is the sort of stuff Buffett does all the time, because it's indicating which shares are undervalued by the market. Now CAPM says there are no such shares, but the guys who develop CAPM said yes, there's plenty of them. So if you actually go for book to market value as your guide, The lowest book to market values give you 10.1%. The highest give you 16.7%. And that's over a fairly good period. So the portfolio with the lowest book to market ratio has the highest beta, so it's very, very risky, but the lowest return. And you take a look at the data, you find you get a tremendous return from going to book value. And in fact, if you plot it, there's the straight line is the prediction of the CAPM's relationship for those portfolios between return and risk. And the dots show you the lowest to highest book to market valuation. And in fact, if you did a regression, that's what you get. Almost perpendicular to what CAPM says will work. So your best return by far is to go for high book to market. Maybe not the highest book to market, you might get some duds down there. But if you go for the 70% to 90% ranking of shares in book to market ratio, the really undervalued, not the massively undervalued, you're going to get a high return with a low risk. You'll get higher still if you go for the lowest or the highest book to market valuation overall, but it's more volatility there. You may get some duds, etc., etc. So he said the CAPM should not be used. I love this. Why not admit it? We got it wrong back in 1969, where he said it was a good first and second approximation back then. Now he says the CAPM has never been an empirical success. This is Fama in French. And he says you can't use the beta as a way of estimating the cost of capital. You'll make the cost too high for high betas, too low for low beta stocks. But he says we still teach it because of the theoretical tour de force. Because that is actually a tour de farce. Having a theory like that to begin with is nonsense. And a true tour de force is something like the theory of general relativity. A theory which is both elaborate, make predictions you wouldn't expect, and they're accurate. And is a far richer theory than this sort of stuff. So they stick with it because they know no other way to work. They warn their own students, or they claim to warn their own students, but they still stick with a theory that doesn't work. So, things like this, the difference between the flatness of the slope of that line, the fact that that plot is the opposite direction to the main one, they're all reasons to reject it. And the founding fathers of CAPM have abandoned it. Now they still abandoned it empirically, they still believe it because they can't think of any other way to think about the stock market. So why on earth are we still teaching this nonsense? Well, a lot of them don't even know they've abandoned it. One reason I teach and read the original literature as much as I can is that I know a lot of my colleagues don't read this stuff. They stick to their own range of reading. They don't read outside their own specialisation. They're not aware that this is actually happening. And they also don't know that there's an alternative. So if you can't teach anything, why not teach? You can't teach anything else. Why not teach what you know, even though it's wrong? So that's the combination of reasons that I think they still do it. But there are alternatives out there. It's just, of course, you've got to go looking for them. And there's two. I'll be talking about both the fractal markets hypothesis and the inefficient markets hypothesis next week. In economics, of course, one consequence of this is that conventional finance theory says finance and economics are independent. You can do finance and look at what's the best equity structure for a firm, or what's the best firm to invest in, and it has no bearing at all on the macroeconomy. Once you say that's not true, you need a combined theory, finance and economics. So that's what I'm going to be working towards as well in future lectures.